All right, this is Flex Fi episode number 7, and I'm John Wildy.
I'm Suzanne Owens, and we're going to get started into a podcast with a solo 401k company that John and I both use, which is called Retirement Guardians. We're so grateful to Jordan Shepard being here with us and taking the time to meet with us to answer a few of the basic questions. And I know just, into my late 40s, I didn't know that this was an option.
I always thought a retirement account was just like getting a mutual fund, having somebody, maybe help you out or buying stocks on the stock market. So, you know, going through and having the solo 401k and then Jordan going through and explaining a lot of things has been super helpful. And then Jordan spending a lot of time with us and kind of talking us through a lot of the setup and a lot of the details has been super helpful.
Oh, it's been amazing. And we really appreciate you, joining us today, Jordan. And I'm going to hand it over to you, and then I'm going to ask you a few questions if you don't mind.
Maybe give us
Okay,
your
well, yeah,
background or with the company.
yeah, you bet. Thanks for having me. So I'm one of the owners of Retirement Guardians. My sister and I own the company together, and we are a 401k plan document provider. So our job is to provide documents to the 401ks that are set up to make them kosher and set up in the way that the IRS wants them to be set up. And then our job is to keep the plan documents up to date and so forth as we go forward, and then also to be here for clients, as they have different questions as they get through and do the different things that they do. So I started in this industry in 2003 and worked with IRAs and also 401ks, and now I work just solely with solo 401k plans. Although, I mean, not a whole lot has changed on the IRA side of things, so I can always talk about that and answer any questions about different things you can do with IRAs as well. But as far as the services we provide, it's only for 401k plans now. So been doing it a long time, seen quite a few things, and have quite a few clients that have done a lot of just interesting things with these kinds of plans. So I'm sure as we get through things and you have different questions about different investments and so forth, I can certainly walk you through some of that as well. But I'll let you kind of take the floor as far as what questions you want to ask, leading in whatever direction, and I'll be happy to answer as best I can.
I appreciate that. And if somebody wanted to invest in an IRA instead of a solo 401k, you could direct them or give us an email or something like that. We could answer that question as well, right?
Oh, sure. Yeah, and I mean if any of like anybody who's listening to this, if they call in and they have some questions about 401ks, but then they also have some questions about IRAs, I can certainly answer any of those questions. As far as any services that they might need for IRAs, you're right. I can certainly direct them to a company that can take care of them.
Okay.
And it's amazing because I know I had some IRAs and IRA type plans, and those transferred really easy and rolled over to my solo 401k. So that was nice.
So who
Yeah.
qualifies for a solo 401k or an IRA?
So an IRA I'll spend just a minute talking about the difference between an IRA and a 401k, just so that as we talk forward, we don't get them mixed up. An IRA it stands for individual retirement arrangement. Most people say just individual retirement account, but an IRA is really for anybody. Anybody can open one up. I mean, you could open one up for your 3-year-old son or daughter or something like. There's no real age restrictions or anything like that. And the reason why is because IRAs are really just kind of like personal retirement savings accounts. And this is the reason why the contribution limits on IRAs are so low. You can only put in 6 or 7,000 a year, just depending on your age. Whereas 401ks are a different animal. They are a workplace retirement plan. So they're not some sort of individual account. A 401k is an actual business retirement plan that then whoever either owns the business or works for the business then typically participates in that 401k. So coming over to a solo 401k, they call it a solo 401k because it's a 401k type arrangement that is really for someone who's just like a single individual self-employed person, whether they're a sole proprietor or whether they do their self-employment stuff through an LLC or a corporation or partnership or something. Typically, a solo 401k is set up where only the owner of the business is going to participate in the 401k and save in the plan. And then you can also bring in a spouse as well. So to get to your question about who qualifies, there are two things that have to be true before you can qualify for a solo 401k. The first is that you have to have some form of self-employment income, and it has to be self-employment income. So we're not talking about, let's say, like investment income or rent money or something like that. We're talking about like an actual active business, even if it's something that you're not doing full time, but maybe on the side. But if you do have that sort of a business, and if you are generating specifically self-employment income, that's number one. And then number two is that you can't have any full-time employees that work for you. Because if you do have full-time employees that work for your business, that means that by law, at a certain point, the law will essentially force you into allowing those employees into the 401k with you as participants. And as soon as that happens, then kind of everything changes with the solo 401k. It's no longer a solo 401k. You're now covering employees, and now their rights and their interests come into the picture. And there's a whole list of pretty complicated rules and regulations that you have to abide by to protect their interests as the employees. So
Now,
the solo 401k
Jordan,
was really,
before you go on, if you have two businesses and one of those businesses does have employees, does that limit you on your ability for the other business that does not?
yeah, that's an excellent question, and that's something that you definitely have to watch for. The answer is yes, it certainly can. Your ownership over through that other business that does have employees, that can, depending on the amount of ownership that you have, that can rise to the level of creating a problem for you doing a solo 401k over on the side. The reason being is that from the IRS's point of view, you are a quote unquote employer through this other business. And so there's a certain responsibility to have parity between yourself and your employees in terms of any retirement plan that you might offer. And so to offer a solo 401k over on the side only to yourself would be a violation of that basic kind of principle. So that's a long way of saying that for anybody listening, if you fall into that category that John just mentioned, where you have a full-time business or maybe a part-time business, but then you also maybe own another company that has employees, or maybe you and some partners own that business together, that's going to be something that I'm certainly happy to take a look at for anyone that wants me to look at it. Because there are some ins and outs as to whether or not you qualify in that scenario. Now, if you don't have that, if you don't own any sort of other businesses with employees, then obviously all that's moot that we just talked about. You wouldn't have any sort of conflicting problem there with qualifying to set up a solo 401k.
So you don't want to really have employees, so to speak. That negates the solo part of it, correct?
Right. And to give just a little bit of context as to where these plans came from, before 2001, when they came out with some new legislation that really, where the solo 401k, as they call it, sprung from. Before 2001, if you wanted as a business owner to set up a 401k plan, even if it was only you, if you were, let's say, a computer consultant and you ran your company through an S Corp and it was just you had no employees or anything like that. If you set up a 401k plan before 2001, you were under the same regulatory and compliance and reporting burden that literally Walmart would be under for their 401k. There was no distinction on who had employees and who didn't. And so essentially what it did was it priced almost all small businesses out of the 401k market. And this is one of the reasons why SEP IRAs became so popular, because they were the affordable alternative to a 401k plan. So real briefly, in 2001, the small business community finally got after Congress enough to say, look, you guys are pricing all these small business owners out of the 401k market because you're forcing them to go through all this compliance to protect employees' interests that they don't even have.
Okay.
So how about we create a special classification for any sort of business that doesn't have employees and that doesn't have these conflicting, employee issues. And then let's say that for them, any 401k they set up is going to be considered a one participant plan, as the IRS calls it, or as we just usually call it, a solo 401k. So anyway, that's where these came from. It was a real attempt by Congress to try to cater to the small business community that had been really essentially closed out of 401k plans. And so any solo 401k is exempt from ERISA, which is Title I of the code that deals with all the employee rights. ERISA stands for the Employee Retirement Income Security Act. So it's a whole list of things that you have to do, and it's there for a good reason, because you don't want some CEO of a company to fly off to Bermuda or something and take everybody's cash. So it's there for a good reason, but there's no need for it when you're in a solo 401k position. And so as a result, solo 401ks are exempt from ERISA, which makes them very, very easy to maintain, to keep records for. There's not a lot of reporting that you have to do each year, which of course we'll talk about probably here in a few minutes. But so that's kind of a long rambling answer, but.
So you brought it up. What is the difference in a SEP and a solo 401k?
So an SEP in its plainest form is really a traditional IRA whose plan document has been slightly tweaked to give that IRA the ability to do a 25% profit share with the IRA. So a SEP IRA is kind of a company version of an IRA account. It is still an individual account that you set up, but it's tied to the income you make through your business. And then the contributions work in a very straightforward way. Whatever your net self-employment income is through your business, you get to profit share with yourself for a maximum of 25% of your income and sweep that into the SEP IRA. So you can put quite a bit more into a SEP IRA than you can just like a normal traditional IRA. However, when you set a SEP IRA up next to a solo 401k, the solo 401k wins out really in all categories, because you get to actually put a larger percentage of your income into the 401k than you can with the SEP. You have more control over the 401k. There's some other cool things you can do with a Roth account and so forth within the 401k that you can't do with the SEP. So the SEP is kind of like a sort of a mini IRA that sort of acts a little bit like a 401k in some ways, but in a lot of other ways not.
Oh, an IRA on steroids, and basically.
Yeah, it's an IRA on steroids, but compared to the 401k, it's still not quite like up to the level of a 401k as far as control and different things that you can do with it. So it's certainly not a bad thing, because you can put a decent amount of money into it each year.
And
Up until 2023, my understanding was if it came up to tax time and you hadn't set up your solo 401k, it was an option to be able to still save on taxes and set up the SEP for the previous year. But now that's changed, right? You can
Yeah,
set
there
up your
used to
solo
be.
401k for the previous tax year. So coming up to tax time, somebody could still set up their solo 401k for last year.
if they could get their documents.
If they haven't done their taxes for this year or for last year yet, they could still set up the solo 401k for last year.
That's right. Yeah, that's right. There used to be a rule for 401ks that basically the year in which the plan documents were originally signed to create the 401k was the first year that you could make a contribution to the plan. And what effectively that meant is like right now, the way it used to be is if you didn't create the 401k and get all the plan documents signed by midnight, December 31, then you won't be able to do anything for that year. And it used to be that the way the rules worked for a SEP IRA, that you could create it the next year and then reach back into the previous year and make a contribution. And the idea there was that you could do that and then essentially just roll the SEP IRA into the new solo 401k and effectively kind of sneakily, although certainly perfectly permissible to do it, but it was a way of slipping in last year's contribution. But as you pointed out, John, thankfully they did away with that. And now you can create the 401k into the next tax year up until your filing deadline, which is April 15th.
Nice.
And still be able to make the previous year's contribution. So,
So what is the limit for a solo 401k, Jordan?
well, so it changes every year. This year, it's gone up quite a bit. For any of those under 50 years old, they're going to max out at 70,000. If you're over 50, the way the catch-up contributions work, you are, oh, sorry, that number has gone up this year to 81,250.
And that's
So
for
it
you and your
depends.
spouse?
No, that's for each person individually. So if a husband and wife or wife and husband own a company and they both worked in that business and they had no other employees, they could do a solo 401k, and then each of them individually, based on whatever income that they show from their business separately, they would then use that to figure out how much they separately qualify to put into the 401k and contribute. So that's a long way of saying that those contribution limits I just said are for individuals and not like for the company itself.
Okay.
And of
So
course,
those
that's
limits,
to income dependent though.
yeah, exactly. So I was just going to say that those limits are the tippy top statutory ceiling that you cannot individually contribute more than that to a 401k plan. However, how much you actually qualify to put in is going to be based entirely on your self-employment income. So your self-employment income is the first metric, the first number you have to have, because it's from that number that then you can calculate how much of this self-employment income you're permitted to sweep into the 401k and then deduct as a contribution.
Is that gross or net?
So it depends a little on what type of business that you have. And by that, I mean what type of business entity you have. So for any corporations where you're paying yourself a W-2 wage, your self-employment income is going to be based on your gross W-2 wages. So
Okay.
only the W-2 wages, they'll look to those for self-employment, and that's it. For any of the other entities, whether you're a sole proprietor, you run a single member LLC, or maybe you and the spouse have an LLC together and you own it together, so it's kind of like a partnership.
Right.
Any of those entities where you're not paying yourself W-2, which is to say that the income from the entity is flowing through the entity and dropping into your lap through like a K-1 or something.
Mm-hmm.
In those entities, you figure it a little bit differently. Since you're not paying yourself W-2, the way they arrive at the self-employment income number is they make you take your net self-employment income.
Okay.
So if you have any sort of flow through entity, then you start with your net self-employment income that you actually report on your taxes. And then if you have a corporation, then it's based on just specifically your W-2.
So what percentage of your net? Up to all of
So
it,
is
or the limit, or what?
Yeah, so what they do is there's two different types of contributions, and these two different contributions are figured a little bit differently, so it can be a little confusing when you first get into it. But basically, for a solo 401k, you're actually making two different types of contributions. The first as your own employee based on the amount of money that you've made,
Mm-hmm.
like you would for any other 401k that you might work for some big company. But then once you're done with that, you also have to then step over the fence. And now you're standing there as the owner of the business that sponsors the 401k. And so you also get to make an employer contribution, which is essentially a profit sharing contribution. You don't do any matching with a plan like this because it's just not nearly as lucrative as profit sharing.
Uh-huh.
So the employee contribution, what you're putting in as your own employee, that is figured on a dollar amount, basically. You can contribute up to, like, if you're under 50 years old, you can contribute up to 23,500 of your self-employment income. That's what you get to put in as your own employee. And if you're over 50, then you get a little bit more because you're over 50 and you get a catch up, as they call it. So you get to put a little bit more in there. Then once you're done with that, you step over the fence and now you get to make a percentage profit share based on your income. And again, this is a little bit differently calculated depending on the companies. If you have a corporation where you're paying yourself W-2, then your company's maximum profit sharing contribution that you can make for your business is up to 25% of your gross W-2 wages.
Okay,
Now, if you don't have a corp and you have a flow-through entity, then you
yeah.
take your net self-employment income and you can contribute up to 20% of that net self-employment income number as your company's profit-sharing employer contribution. And that is a deduction to your business since it's your company making it for you.
So let me just do a little run through here. If we had two corporations, one's an LLC and one's a S corp, and they're both making 100,000 for simple math, and they were under 50, they could put 23.5 each in both. And then they would put 25% if it was S corp, and it would be 20% if they were LLC.
Correct. Correct.
Okay,
Yeah, so the only difference between a corp and like some flow-through entity really in figuring things is going to be just that with the corp that again everything is based on your W-2 income and that's what you're always using to calculate off of. Um, but you're exactly correct. And I can send you if you wanted to put it maybe in the show notes or something, I can send you a link to a really handy solo 401k contributions calculator
yeah.
where you just put in your age and the type of entity you have and then your income and then it just calculates what your maximum contribution would be. It even gives you like a breakdown in comparison to like a SEP IRA or a simple IRA, some other like, version of an IRA just to give you a comparison. Although
Okay.
you can always put more into the 401ks. So I mean you'll see that when you plug that stuff in. But
That would be great, and we'll attach that to the show notes. So if somebody wants to come to you or any other company, what are the costs in general of setting up your own solo 401k?
yeah,
What
so the costs,
what are they range
yeah,
cost?
so our prices, our setup fees haven't moved since we started offering 401k. So we charge a setup fee of 1,200. And we generally will charge if you have a spouse where they're going to be in the plan with you, we charge an extra 200 because we have to deal with them as far as like helping them get stuff rolled over to the new plan.
Right.
So typically it's 1,200 for a one person 401k and then 1,400 for if it's a two or more person solo plan. And then the way we work it is we are the 401k's document provider. So it's our responsibility to make sure that the documents always stay updated and that they're approved and kosher and so forth. As to the day-to-day operations of the plan, that's left entirely up to the client. So the
Okay.
client is their own trustee. They choose where they want to hold the retirement funds in a local bank account or in a trading account or spread out over a few accounts. And then what they choose to invest in is their business. So we don't charge any sort of like administration fee or anything like that. The only fee that we charge on an ongoing basis, starting the second year after the initial setup, is just basically a document fee for using our documents and for us keeping them up to date. And we charge a flat fee of just $200 for that each year. So you'd have the initial setup fee of 1,200 or possibly 1,400 if you had more than one person in the plan. And then starting the second year, the maintenance fee would just be $200 a year for the continued use of the plan documents.
And I know when I go into the website and I sign in, then you guys have a great information source. Is that available to somebody who's just considering opening up a solo 401k, or is that only for current
Clients.
clients or subscribers?
No, so we're more than happy to, if somebody wants to get a look at the site before as they're making a decision, so they have a little bit better idea of what they might be in for if they did it. We're more than happy to give them a login to the site. The
Okay.
site is really intended, it's more the reason why you have to log into it is that because it's because it's a specific solo 401k site dealing with not just with 401ks, but a certain type of 401k, and also because we do our plan documents the way that we do them. I only want clients on that site or people who might want to be a client, but I don't want somebody from maybe some other company,
Reaching
who maybe set stuff up slightly differently than we do to maybe read something on our site. So that's the reason why you have to have a login to get in. But yeah, we're more than happy to give a login to anyone who'd like to look at it.
So what does it mean to like have checkbook control versus another type of solo 401k?
Well, what it really means is, I mean, to compare, I think John, you had said earlier, like when we first started talking, that when you prior to setting all this up, if somebody had said the word retirement plan, that you would have thought of stock market, mutual funds, that sort of thing.
Right.
And that's what most people think of. Um, and that I think partly has to do with the history of retirement plans when they flipped the script in the country, but from essentially back-ended pensions to more front-loaded retirement plans like a 401k. One of the necessary consequences was that these retirement plans that you could now like direct investments as far as trading and so forth, a lot of the big brokerage firms ended up being just already in a position to take those accounts. And I think that that's one of the reasons why, in the average American's mind, when they think of retirement plan, they think of just like the stock market, and that's pretty much it.
Mhm.
And investing in anything outside the stock market seems kind of weird to them, or like you shouldn't be able to do it or something. But the bottom line is that retirement plans have always been allowed to invest in almost anything, with a few exceptions. There are some restrictions they put on retirement plans. But to have an account that is self-directed means that you have a retirement plan where whatever investment decisions that are going to be made by you. And typically it also means that you're setting up some sort of a plan that doesn't have any artificial restrictions on the plan, in
Mhm.
terms of it doesn't have some clause in the plan documents that says, the only permissible investments will be publicly traded investments. So there's nothing in there like that. So having a self-directed plan typically means that you actually control the plan in terms of making decisions to invest in this or to sell that or to open some other account. And then secondly, it also means, in terms of the abilities of the plan, that the plan doesn't have, again, any sort of artificial restrictions that would keep it from doing something that otherwise the law would allow you to do. It's just that these documents somehow restrict it. And that's what you run into. Like if you opened a Fidelity IRA, for example, Fidelity is a public broker, and so they broker publicly traded securities, and they can act as your broker, and you can use their system to log into and to select this mutual fund or buy this or that. But if you wanted to buy, let's say, a rental house, or you wanted to make a hard money loan to some friend who's starting a business that you think is really going to do well, if you went to Fidelity and wanted them to do that, it's not that you can't do that sort of thing with an IRA, or even if you had a 401k with Fidelity. It's that Fidelity is not set up to handle and process that kind of investment, because they are the custodian in that case of your retirement plan. And so ultimately, they're the ones holding the money, and they're the ones that have to sign off on whatever it is that you might want to do. And in this case, it's not that Fidelity doesn't want a person to buy real estate, it's that they're literally not set up to process that kind of investment in a retirement plan. So setting up a plan like this, essentially what you're doing is you're pushing a third party custodian like a Fidelity or a Schwab or a Merrill Lynch or something. You're pushing them out the door, as it were, and you're stepping into their place. You literally become the custodian to the plan, which means that you're the one that makes all the decisions on where the funds for the 401k are going to actually be held, what investments you're going to do, whatever you need to do to get through that investment, show up at closing with a cashier's check or wire money over here or there, or, have an attorney review some contracts or documents based on whatever you might be doing. All of those things, being the trustee of the actual 401k plan, is something that you can do yourself, and that you're not relying on someone else to do for you, where they might charge you a fee to do that, or they might in some way stop you from doing this or that because it doesn't, again, fit in with how their system works or something. So that's generally what it means when someone says, I have like a truly self-directed solo 401k plan. It means that there's no one else sitting at the table, as it were, with you, that you're the only person who has any sort of authority over the plan. Um, and that you are permitted within the plan documents to make whatever investment that is permissible by law.
So can you give us some examples of different things people have invested in with their solo?
Yeah, and I'll start real quick I think it's easier to paint the picture of the way the code works. There's not like some section in the code where you can go and get a whole list of different things that you can invest in with your retirement plan. It
Mm-hmm.
actually works in a negative fashion. So it identifies a few things that you're just not allowed to invest in at all under almost any circumstances with retirement money.
Mm-hmm.
And then anything that is not under those specific, restrictions you're permitted to invest in. So the restrictions are really not very many. You're not permitted to hold most forms of life insurance contracts in a 401k, although there are some exceptions to that for certain life insurance policies where you can have the 401k pay the premium. So there are some exceptions to that. But generally, as far as an investment, you're not allowed to hold insurance contracts. And then the second thing is that you're not allowed to invest in anything that might be considered a collectible. So this would be something like, fine wines or old paintings or some collectible book or something like that. I think generally it would also refer to collectible cars as well, although there's some debate on that. And then the other set of restrictions deals with the people, the individual persons, and let's say entities that the 401k cannot deal with. And essentially, it's a short list of people, but the list of people that are prohibited from dealing with the 401k are essentially the 401k owners and their immediate family, because there's just too much of a possibility of a conflict of interest there. At least that's how they view it. So the 401k owner and then their spouse, if they're married, and then straight up and down their family tree. So their parents, their grandparents, their kids and their spouses, their grandkids and their spouses, those people are considered disqualified persons to the 401k. And that means that they can't have any dealings at all with the 401k as far as business or investing. So as far as investments, like what's permitted, I mean, aside from the life insurance restrictions and the collectibles restriction, there really is no other restriction in regards to what you might want to invest in. So any form of real estate would be fine, whether it's residential or commercial or farm ground, or whether it's just buying 10 acres that you think maybe one day you might build your dream house on. You buy it in your 401k and just leave it in there. It's not even producing income. That sort of thing is fine. Um, investing in things like tax liens and trust deeds, loaning money to people and taking a trust deed or a first mortgage as collateral, that sort of thing is fine. Um, I see a lot of clients get into, crypto and precious metals. We have some clients that get into things like, I think they call it angel investing, private equity investing in kind of startup businesses that you think might pay off. Um, and then also we have a lot of clients that in addition to the non-traditional stuff they do, owning some real estate, making some loans, they'll also open a trading account in the solo 401k's name, let's say at Fidelity,
Yeah.
and they can just go ahead and trade in addition to the non-traditional stuff as well. So that's one thing I would say is that if you go this route with a solo 401k, I mean, a lot of people go this route because they want to get into non-traditional investments, but just understand that if you set up a plan like this, that's not the only thing you can invest in. You can still certainly invest in traditional, publicly traded securities. So you can have the best of both worlds. But the point is, of course, wherever the funds move, whatever investments are done, you're the only person, as again, the trustee of the plan that controls what is going on within the plan. And your only real limit is nothing in the plan documents, but the actual tax code, in terms of your ability to do this or to do that. So again, no artificial restrictions on the plan.
So what are the reporting requirements to the IRS for a solo 401k? Do I've got to fill out a form every time I make a trade or buy into a company or give a loan, or what is it?
Yeah, good question. So um, as far as reporting, like tax reporting, there's obviously going to be some element where contributions to your 401k will cross over and end up on your tax return because you're going to be reporting those contributions and taking the deduction for them on your personal and on your business tax returns.
If you do it
So as far
pre-tax?
as that goes, Yeah, if you do it pre-tax. Now, I think we'll probably talk about the Roth 401k. So you can make contributions to the Roth 401k, but they're just not deductible. They have to be on an after-tax basis. Um, so as far as that goes, I mean, it would be just your normal reporting on your taxes of whatever it is that you're contributing into the plan. So there's not really going to be much of a change there or a difference there. You just keep doing what you're always doing, which is reporting your contributions. On the 401k side, as far as reporting to the IRS, there's really not much there, and it depends on the total value of the plan. So with solo 401ks, the IRS has carved out a certain form that you file with them each year, but only if the total assets of the 401k exceed 250,000 by the end of the year.
Do you see that
So if
going
at the
up?
end of I don't know. That's a good question. With inflation and so forth, I don't know. We might see it go up to 275 or 300. I haven't heard any rumblings on that, but that's a good question. It wouldn't surprise me if they do eventually bump it up. So, so for any solo 401k, at the end of the year, if your plan's total assets, and I mean the cash that's sitting in the checking account, the real estate it owns, maybe some trading it's done, but all the assets of the plan, if it's, let's say, 220,000, then you file nothing with the IRS the next year because the plan isn't worth enough for them to want, that filing.
Mhm.
But if on the other hand, let's say it's 300,000 at the end of the year, 800,000 or something, well, obviously being over that 250 mark, then you now have a 2-page report that you have to file with the IRS. It's called a 5500 EZ.
Mhm.
And it's different from the full-blown 5500 that all other 401ks have to do. That's like a 9 schedule monstrosity of a return. So you should be thankful you don't have to do that. This is just a 2-page report. And I think you've seen it on the site. We have a complete line-by-line walkthrough of the form. It's a very simple form. Once you get through it the first time, it probably takes you 10 minutes to get through it, and probably 85% of it is the same every single year. So it's a pretty basic form, but it's really just an over/under rule. If your plan is under 250 at the end of the year, you don't file that report. If it's over 250, then you do have to file the report. But even then, it's not due until July 31st. And we send out reminders to clients, hey, it's about that time, just remember that you may need to file this form. Um, so there's not a lot of reporting directly to the service, except for just that 2-page report. And then just like I said, just the normal tax reporting that you would do anyway, because you're making contributions to a plan. Now,
Of reporting, that whole BOI mess. Hers is an LLC, mine's a trust, and there was some kind of question as to if we had to file that or not.
right.
I don't
Yeah,
know.
that was such a cluster. And I'm thankful. I mean, the BOI or I forget
Sounds like it's not
what
important.
group that runs through. Yeah,
Yeah.
thankfully, I mean, that was back and forth, and the court slapped it down, and then they didn't, and then they slapped it down again, and then President Trump came out and pretty much made his stance clear. So I think that as of right now, I think it was yesterday, they put up a statement on their website, like with final clarity as to the fact that BOI filing is dead.
Okay.
Um, so I guess everybody should check that with their CPA. I mean, it seems like there might be some exceptions, but for what we're talking about here, for like our clients with their 401ks and any underlying entities that those 401ks might own, there doesn't appear to be any requirement for them to file.
Okay.
And there hasn't been since the first part of the year, thankfully. So that's one less thing to have to worry about.
And just for reference, you're talking about March 27th, 2025.
Correct. Yeah, it was. I think it was yesterday, so March 27th. The BOI filing group. I can't remember who it is. FinCEN, I think. So
Yeah.
FinCEN put up a statement on their
Yeah.
website confirming that those entities don't have to file.
So last year, John and I were sitting here in South Dakota, and there's nothing to do where we work. And I was like, hey, and I was like, John, do you have your Roth started? Because the time starts ticking from the year that you open or contribute to your Roth. Can you explain the Roth component of the solo 401k to us?
Yeah. So The easiest way to explain that is to contrast it real quick with the way that works with an IRA, because it also shows that the 401k is just a lot better because you get to pull everything under one roof. So with IRAs, I'm sure everybody's familiar with a traditional IRA, just a normal pre-tax, tax-deferred IRA. And then I'm sure most people are familiar with a Roth IRA, which is the exact opposite. It's an after-tax IRA where contributions are not deductible. Now, with IRAs, if you have a traditional IRA and you have a Roth IRA, that means you have two separate IRAs, two separate entities drawing two separate custodial fees from whoever's holding them and so forth. And if you wanted to take some money that's in the traditional IRA and convert it to the Roth, or if you wanted to contribute to the Roth, you would do so directly to the Roth account, but you would still have to have these two separate IRAs. And there's no way to set up an IRA that combines both the before and after tax sides of like a traditional and a Roth IRA. Now, a 401k, when you look over at that with a solo 401k, you don't have two separate accounts here. You actually have one. And the best way to think of it is the 401k plan, even though we call it a 401k, what we're really doing there is just referring to the section in Title 26 that deals with this type of like workplace retirement plan. So Title 26, Section 401k.
Right?
Yeah, exactly. And so if you hear the term like 403b or 457, those are all retirement plans, but they call them that because they're referring to the specific code section. But if you ask the question, like, what actually is a 401k plan? Like when I go to set this up, I mean, how do I open a bank account or how do I wire money or like, what am I signing for here? Well, what it is sitting in the center of your 401k plan is a trust that holds all of the assets of your 401k plan. And this trust has a certain name, it has a certain tax ID number, it has a trustee, which is you. And so this trust can go into any bank and open an account, can, obviously being the trustee of the trust, if you have to sign anything on the trust behalf, you can do so. Well, the way a Roth account works in a 401k like this is the trust that holds all the 401k's assets has the ability to internally split and segregate monies for different reasons that might make your life as the trustee easier.
Mm-hmm.
And one of the ways that you can internally split this money is to split it off into where you open, let's say, a separate checking account in the 401k trust name, with you still a signer and all of that. So it's like a carbon copy checking account of the 401k, but it's just got a different account number. And then you get to, as the trustee, having internally segregated and separated now into two separate accounts, you get to treat one of those accounts as the Roth 401k.
Okay.
And now going forward, any contributions you might want to make specifically to the Roth side, you just make sure that you deposit those monies into the Roth 401k's specific Roth account. And then likewise, if you're going to do an investment specifically with the Roth money, you would draw a check off of that specific account or make sure that you wire the money from that account. So basically what you get to do is if you decide that you want to do something with the Roth 401k, you're not required to go out and open some brand new, entirely separate retirement account.
Mm-hmm.
You get to just internally carve out like a little corner of your 401k's trust and treat that as the Roth 401k. And then obviously you keep track of, as you make different contributions, you're going to have to report that differently because, Roth contributions are not deductible. So not much changes. It's more of just a matter of just carving off that corner. I tell clients, like, think of the 401k trust like a house. And the Roth section of the 401k is the upstairs. So as long as you're downstairs, you're dealing with before tax, just regular 401k monies. But the moment you walk upstairs and go up into the Roth section of the house, you're now in the after tax Roth section. And so that's maybe a dumb example, but it goes to show that when you want to do something with the Roth side of the plan, a few things that are important. Firstly, you don't lose control of those funds, because those funds still stay within the 401k trust that you're the trustee of. Secondly, it also means that you're not having to open some new separate account. And thirdly, I'll just mention this not to confuse things, But thirdly, the other nice thing is that the funds have stayed under one roof, meaning that your before tax monies and your after tax Roth monies are still within the same entity, which means that you can actually combine those monies to do investments if you want to, so long as you track the equity split. And by that, I mean, if you wanted to buy a piece of property, but you didn't have enough in the Roth side of the plan, you didn't have enough in the normal side of the plan, but if you could somehow combine these two types of money to go buy the property, you would have enough to go do it. I'm saying that yes, you can do that with the solo 401k. You just have to make sure that you know that the original split was 60-40 or whatever, because obviously as profits come back, or if you sell the place or something, those two types of monies went in, so you're gonna have to make sure that they come back out proportionally. So
I think just two more things I want to hit because we want to be respectful of your time and viewers' time and that sort of thing. But
sure.
what is the most interesting investment you've seen, or the greatest return? Either one, like.
Oh, well, I think probably the greatest return would have to be just numbers wise crypto. Because I have clients that bought crypto years and years and years ago in their 401k, bought Bitcoin back when it was $500, kind of thing. And now it's, I don't know, whatever it is, 10,000
Mhm.
or 60,000, whatever it is. So I would say probably numerically that's probably been the biggest gain. But moving that kind of extreme situation off to the side, probably the biggest gain that I've seen was a private equity investment that a client of mine in California made. And I think he said he made something like 50 times what he'd invested in the company.
Nice.
Um, that was, like an angel startup kind of a thing. So that requires kind of its own special, like understanding and expertise and all that. But as far as the weirdest investments, I had a client one time ask me, and I got him an answer as best I could, but I don't know if he ever decided to do it or not. But he apparently knew some professional gambler who was really good at, I can't even remember what it was they were gambling on. I think it was horse racing.
Hmm.
And he asked me if it would be permissible for him to make an investment with this guy as far as gambling. And it was a really tricky, thorny question. I had to call a couple of attorneys I knew. And I eventually sent him a note basically saying, I don't know that I would do that if I were you, but I can't really find anything that specifically prohibits it. So, take that for what it's worth. So I don't know if he ever did it. I don't remember him ever calling and telling me, but that's probably the weirdest investment, to have somebody ask if they can use it to gamble with. But as an investment, so that was kind of strange.
As long as he's not the one gambling with it, right?
Yeah, exactly. And that's the big concern, and of course gambling, there's a fiduciary responsibility element that gets involved because as the trustee of your own plan, you have to always act in the best interest of your own plan, which you're going to do anyway because it's your money. So it's not like you're managing someone else's money.
Hmm.
But to gamble is that a violation of that? It seems to me it would be, but who knows? So that, like I said, I wasn't able to get a real clear-cut answer for him on that, but it was certainly a strange question.
Well, I know that you have been a great mentor or advisor to Bill and I, and I'm sure John as well and
Absolutely.
his family. And one of the things that you taught me and that I was able to do is I wasn't realizing that I could take my pre-tax, even if it was, so I'm going to use my own personal example, as we bought a investment property in a gated community, and we took that property and we rolled it out to a Roth, which was a great strategy for us because since we've rolled it out, it's continued to gain at least another 100 to 120,000 in value, and the rents
Right.
are Roth. So I'm not sure that people understand that they can take a pre-tax investment and roll it into a Roth conversion if it's crypto, cash, investment, real estate, anything you can think of. Is that correct, Jordan?
Yeah, that's exactly right. And I'll just say this real quick on Roth conversions. I mean, Roth accounts are, I mean, as we used to say in the 90s, they're the bomb shizzle. I mean, they're once you get them set up and you get money into them, I mean, you just don't ever pay tax ever again. And also importantly, neither do your heirs pay tax on that account. And the important thing is that whatever that account might grow to in terms of its size is just available to you completely tax free. So Roth accounts are great, but the thing, you can't really provide an answer to like, should somebody do a Roth conversion or do something with a Roth? It's hard to say yes or no because it really depends on their situation.
Right,
Because whatever you get into the Roth account, you got to pay tax on. Like new contributions, you don't get the deductions. You got to bite the bullet and pay tax right now,
Mhm.
knowing that once you get the money into that Roth, whatever it grows to, it won't be taxed again. And then, like you said, with conversions, whatever the value of the thing that's already in the retirement plan that you're going to grab and convert over to the Roth side is what they call an in-kind conversion. So you're converting an actual thing. So long as that thing can be valued and that can be attested to by a third party, such that you set the value of the conversion, which then tells you how much income that you have to take and then pay tax on. But yeah, you can do that sort of stuff all day long. And so then the question really becomes if a person likes the idea of having a Roth type account, then it's really a matter of sitting down and looking at their situation and figuring out how can I start shifting, how can I start maybe putting new money in the Roth, and how can I begin shifting what I've already got over to the Roth side, but do it in a way where it's not going to just bankrupt me in taxes, because of course you got to pay tax on whatever you convert.
right,
And that's what gets into what you were talking about, where there's some really interesting and cool ins and outs that when you're going in and structuring a conversion, a lot of times you can get in there and do it pretty cheaply. And by that, I mean, end up saving maybe 25 to 40% in taxes just by knowing how to structure it correctly.
right.
So yeah, I mean, Roth accounts are awesome, and I would suggest anybody to really look at them. And then if a person likes them, then there's a lot of ways that you can kind of, plan to segue over to that type of account and make it work for you instead of work to for the IRS's benefit.
Right.
Absolutely.
So sometimes the tax strategy is the important part, is what's your end plan and what works for you and one of the valuable things you told me when we were opening up our account was invest in what you know.
Right, right. Yeah, and I'll just tell real quick something that I tell a lot of clients years ago. I mean, this was probably 15 years ago. I had a client in Arizona who was worth a bunch of money. And he was a self-made guy. He'd started with hardly anything and he got into real estate and had done almost everything that you could imagine in real estate. I mean, he'd owned mortgage companies, he'd owned construction firms. And so he called out of the blue and we chatted up and we set him up with a structure. And I remember him calling a few months after he got it set up, and he was like, I'm blown away. He said, all this time I've made all this money. And he said, I've always just maxed out every retirement plan I possibly could because I could afford to. And he said, for years, he said, I'd log in and I'd talk to my advisors. And he said, I had no idea what was going on in my accounts. They try to explain why my account was down this much or why it was only up that much,
Mm-hmm.
And, but he said, he said, I didn't know you could do this sort of thing. He said, now I can take my retirement money and go invest it in something that I know for sure that I'm going to make money. And I
Right.
know for sure that I can control my risk and I can, so that's something that stayed with me, and that's been kind of a recurring theme that I've seen with clients, that when they kind of get into it and they get their feet wet as far as the nitty gritty of how it actually operates and works, and then they get off and start doing whatever investments they get into, that's one of the things that it's almost like, geez, I wish I would have known about this 20 years ago,
Right.
So
Yeah.
Well, we're trying to get the word out about this, and I know with John and I both doing anesthesia is we'll probably put this up on our business website for other people
I'll put it for
providing.
other CRNAs too.
Yeah, that
Sure.
they don't know what a solo 401k is, or they don't know what they can do with it, and it's an awesome tool that anybody could use if they have, like, we go and provide locum coverage for anesthesia. And so
Right.
that makes us well, it makes me a sole proprietor. John's a S corp, but it makes us qualify for this solo 401k option. And I really appreciate all your education and your information today.
And we'll put a link
Oh
down
yeah.
below, so if there's any extra links or anything that you want us to link to, definitely give us those and
That
we'll
calculator
add
you
it.
talked about would be
Yeah.
great.
Yeah. Yeah. I'll send you the calculator. One other quick thing I'll just mention, because a lot of times people don't know that rollovers can be done this direction. You can roll any retirement plan with the exception of a Roth IRA and an inherited like retirement account.
Mhm.
Any of those retirement accounts with those two exceptions, you can roll into the solo 401k. So
Awesome.
just so we're clear on that, because some people, it's like, well, hey, I've got an old rollover IRA or a traditional IRA. I can't roll that into the 401k, can I? And of course, the answer is yeah, you can. Most people are just used to going the other way, like from an old 401k into an IRA. But just so you know, you can go the other way. So point is you can consolidate if you have a few accounts here, there, and yonder. If you want, you can consolidate them all into the one 401k plan if you choose to. So,
And
but
that's
yeah,
what you help with the your company is getting that money. I know I took a old 401k and Bill took a different tax ID number. He was working for the state at the time, and we rolled them into one plan and started out our investing with our solo 401k. So that's part of the fees that you're charging is you help with all that rolling over, right?
yeah. I mean, our job is the setup of the plan. So, of course, all the documents and understanding how to open different accounts and what your options are there. And then we just have, as you guys know, we've just always had an open door policy. I mean, if you need something as you get through the deal 5 years from now, call me. If you're sitting at closing and some attorney has a question about this, that, and the other thing, give me a call. Be happy to help if we can. So yeah, our door is always open, and that's just kind of an ongoing, just running thing. But obviously, the setup is the initial setup, the documents, opening accounts. One thing I will say is when clients roll, as you guys know, when you roll funds into the plan, again, we're not your custodian, so you'll be receiving those funds directly and just putting them directly into the 401k's account.
Right.
So again, all that stuff, that's how we come in and walk you through, like, here's the next step, do this, do that, do the other thing. But we can't actually do it for you because again, we're not the custodian. So I just want to make that clear. But yeah, our job is to walk you through all that and to make it as simple as possible. So
We appreciate everything, Jordan. And like John said, send us the information. We'll include it in the show notes, and then people can use that information to make better decisions. In my opinion, this is some of the best money I've ever paid in my life because it's made me so much more money. And Bill and I have this will be our 4th year reporting for filling out that 5,500 form of being over 250. Whereas we started
right.
with about 135, 140,000 from our old retirement accounts, and it's grown quickly because we invested in what we know.
Yeah, that's great. Yeah, I love to hear that. I love to hear that. Well, I'm glad that we could be a part of it. I'm always happy to help whoever's got questions about, this is what I tell people is this is a unique enough kind of area that anybody that's interested in it is sort of automatically my friend. And it's fun to chat with them about what they're doing, So, so
Yeah.
yeah, if anybody has any questions, I just let me know and I'll send you the calculator link for the contributions and then maybe a
Awesome.
couple other links. And
Okay.
yeah, I appreciate you guys having me on. And
All right.
anything
Sounds
you
great.
need from me, of course, follow-ups or anything, just let me know.
Thank you
Sounds
so
great.
much, Jordan. Have a great day and have a great weekend.
All right.
Yeah, thank you guys. Talk to you later.
Bye-bye.